Hello. Our company, Company B, is in the muesli cereal market. The market that which we distribute is to the grocery store and big box retailers throughout Germany. To those retailers, we sell strawberry, original, nut, blueberry, mixed, and raisin muesli. The purpose of our company is to deliver high quality muesli at an affordable price to as many German customers as possible.
We have 3 members in Company B. First, Noah Bastable is in charge of sales and analyzing the sales. Second, he is in charge of the marketing expense. Scotty Dye, the second member of the team, also the team manager, is in charge of pricing, financial analysis and forecasting, as well as calculating our requirements. Brody Binge is in charge of purchasing materials and releasing our product.
For part 1 of the simulation, we stuck to a competitive pricing strategy. We constantly kept a look on the Z market, or the price marketing report, and sold around or lower than the market standard price to maintain our competitive prices. We also focused on selling as much as possible. We kept track of daily sales to see what was selling, and whenever a product was not selling well, for more than 2 days, we adjusted the marketing fees. We always checked inventory and ordered new stock before we ran out of inventory.
Our overall financial ranking was good. We placed in the top 3 companies for both round 1 and for round 2. Our success could be attributed to several factors. Our high revenues bode well for us because it will increase our margins, assuming that we can keep our costs average or below average. This will also allow us to stay true to our strategy of low pricing. We also had the second highest sales after round 2, which means that our pricing strategy is working well. Based off of these comparisons, we can conclude that most of our financial success and profit margins are due to the effective pricing strategies as well as the amount of revenue sold.
Net margins were a little below average. This may have been because we had lower pricings as part of our strategy to sell more product. In the future, we could increase prices somewhat to increase our margins. Our debt to equity ratio was lower than most groups, which is a good thing in this case. The lower ratio means that we are lower risk for investors, which theoretically could bring in more capital to expand our business. Finally, our marketing as a percent of sales was on the higher end of all of the companies in the simulation. We wanted to make sure we were selling as much of our product as possible because that meant more revenue. The increased marketing costs helped, and it was still a very small amount of our total costs. We primarily focused on net income, cash, cost of goods sold, and selling, general, and administrative fees. The first 2 we tried to get as high as possible, while the other 2 we wanted as low as possible. At the end of round 1, we had a high net income in cash, so we figured we were doing better than we expected. Selling, general, and administrative fees got higher every round because we thought we can spend more since we did well in the first round. We probably could have been more conservative about how much we put into marketing.
As a whole, we are confident in our ability to produce and sell muesli to our German market. We ended phase 1 with success, but will certainly not be complacent going into phase 2 of the simulation. As stated earlier, our gross and net margins are slightly below average, but we have done this intentionally so that we can supply as many customers as possible and fulfill our mission statement. Going into phase 2 of the simulation, we will continue to price our products slightly below the average of the market, but we will creep closer to that market. Getting closer to the average will increase our margins and in turn make our company more profitable. We will also decrease our marketing expenses to be more competitive with the other groups in the top 5. Lowering our marketing also positively correlates with increasing our profitability.